Hey everyone, and thanks for jumping back into the cryptoverse. Today, we're going to talk about the Ethereum Bitcoin valuation and the Ethereum Bitcoin risk metric. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the Telegram channel, which you can find a link to in the description below. Remember to check out the sale on the premium list, which will be ending on Sunday. Let's go ahead and jump in. So again, we've been talking about some of these risk metrics, and we haven't spoken about them on the channel in a while because I generally like to keep that for the premium list when things are going crazy. But I do want to occasionally show what the premium list is all about and show some of the things we use. So this is the Ethereum Bitcoin risk metric. The idea is, if you look at it, it goes from 0 to 1, color-coded blue, to color-coded red based on where the risk is. And also note that the primary y-axis is a logarithmic scale. And so the general idea is that, hey, there's going to be times when the Ethereum Bitcoin volatility is really high, and sometimes if it's to the upside, you might want to take profits back to Bitcoin, and if it's to the downside, then you might want to take Bitcoin back to Ethereum. And so this is what it looks like. Now, again, as we've showed before, looking at it when it's based on color, while visually appealing, is not the best in terms of coming up with a strategy because it's hard to see what's going on. But if you take the color code out and then just look at the risk metric, it looks like this. It's the yellow line. The white line is the Ethereum Bitcoin valuation. So the yellow line is the risk metric. You can see that there were 2 times in the last bull market when it went to 0.9 to 1 risk. So far, you can see it's between the 0.6 to 0.7 risk band. Now, the general idea is, depending on what your own risk tolerance is, and depending on how bullish on Ethereum you are or Bitcoin, whether you're trying to get more Bitcoin, whether you're trying to get more Ethereum, you could come up with a strategy where you buy Ethereum with Bitcoin when it's in these lower risk levels, and you sell Ethereum to Bitcoin when it's in these higher risk levels. And you could do it dynamically, so that maybe down here you're selling a really small amount, and as it scales up, you increase that amount. In the same manner, maybe if you're buying Ethereum with Bitcoin down here, maybe you buy a little bit here, and then if it goes down to this risk level, this risk band, you do even more. And then again, if it goes down to the next one, you do even more. So this again is just another risk metric that we use. I mentioned that we have risk valuations not only against the US dollar, but also against Bitcoin and many altcoin Ethereum risk valuations as well. So the general idea is, day trading is really difficult to do. And I think most people do lose money day trading. But if you have sort of a macro approach and you just try to time key shifts in the market and slowly scale out of positions rather than an all-in or all-out approach, you could come up with a strategy like this. Now, if you're super bullish on Ethereum and you just want to occasionally take profits back to Bitcoin, you could do something like this where you just mindlessly buy Ethereum until it gets to these higher risk levels against Bitcoin. That would certainly be one strategy. But the point is to recognize that I see a lot of people talk about going all in or all out, which I think is not a great strategy in crypto, especially when you're dealing with the blue chips like Bitcoin and Ethereum, because you really don't want to miss a major move by either of them. So slowly scaling in and out of positions, slowly reweighting portfolios over macro timeframes, I think is the right strategy. One of the reasons why I think this is the right strategy over, DCAing, not DCAing, but trading constantly is because if you're in the United States, you're going to incur a lot of tax implications, and who wants that? The taxes alone can eat away a lot of your gains if you're just constantly trading taxes or constantly trading crypto back and forth, and you're paying short-term capital gains all the time. It's much more attractive if you can, while it lasts at least, to get to long-term capital gains and maybe take profits occasionally if the risk metric calls for it. Because while it can be attractive to just hold forever, there could be some times where it would make sense to make a trade. Think about early 2018. A lot of people would have been much better off had they taken profits than just holding for 3 years. But that's the point, is to say, hey, we don't know exactly where the top is, we don't know exactly where the bottom is, but if you just slowly scale out of a position as it goes up the wristband, or slowly scale into it as it goes down the wristband, then I think it helps manage your risk accordingly. So there's a lot of talk about ridiculous price predictions. I've seen people talk about Ethereum going to like 100K this year, next year. It's just ridiculous price predictions that don't really mean anything. But there's a better way, I think, to navigate these markets, and it's to actually have risk involved. I think a lot of people don't necessarily incorporate risk into their into their strategy. And if you don't incorporate some measure of risk, again, it doesn't have to be this risk metric, it could be something else that you make up. But if you don't incorporate risk in some way, then you're sort of setting yourself up to maybe not do so well or react based on the emotions of the day. So whether you want to use this one or not, I think is irrelevant. If you don't want to use this one, I think that's fine. Come up with your own, right? There's other ways you can come up with risk metrics. Come up with your own, and then just follow it, right? Follow that strategy. So no matter what happens in the future, whether you think, oh, well, this time is different, assume that it's not different. Okay, I think if you just assume that it's not different, then you'll be pleasantly surprised if it is, because again, you're not doing an all in or all out approach, but you're also making sure you take profits in case it's not different. Okay, so that's the general strategy that I follow. Remember, if you want access to these risk metrics, check out the sale on the premium list. We're going to raise those prices again on the here in a couple days, so make sure you guys check that out. I think that generally covers, this risk metric, but you can see back in 2016, we came up to the 0.901 risk band, and in 2017, we came up to the 0.901 risk band, but then in early 2018, we didn't. And you might say, well, Ben, in early 2018, Ethereum went on a crazy run. It still made it to the 0.6 to 0.7 risk band, but remember, it was with respect to Bitcoin, and Bitcoin was also off the end of an amazing run as well. So, I mean, if Bitcoin had been like $1,000 at this time, and Ethereum was at 1,400, then the risk probably would have been up here. But the fact that the fact that Bitcoin was up like 100x or around there, made it so that the Ethereum valuation, the Ethereum risk against Bitcoin wasn't as high. So there were other times earlier where it was high, and then therefore taking some profits of Ethereum back to Bitcoin up here would have made sense, because then Bitcoin went on a crazy run, and that's why the Ethereum Bitcoin valuation bled. Okay, so this is how the risk metric works. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the Telegram channel, which you can find a link to in the description below. Remember to check out the sale on the premium list and lock in the lower rate. You have a couple more days. Thank you for tuning in. Definitely subscribe. Let's go for 500,000 subscribers. Click the bell icon to turn on your notifications, and I will see you next time. Bye.